Welcome to another episode of Leverage Addicts. It's Blandon here, and on this episode of our podcast, we have two special guests, Jack and Carl from Provincia Property Fund. They're here to share their expertise on the world of commercial real estate investing and how residential property investors can benefit from expanding into this realm. As founders of Provincia, Jack and Carl have a wealth of knowledge and experience to share, including how they made the transition from residential to commercial real estate, the challenges that residential investors might face when making this transition, and the fundamentals of commercial real estate investing. Now, whether or not you're a seasoned investor or just starting out on your investing journey, this episode is sure to provide you some valuable insights and tips to help you navigate the world of commercial real estate. So sit back, relax, and join us as we explore the exciting opportunities that commercial real estate investing can offer. Welcome, Jack and Carl.
Hi there.
Hi. Thanks, Blandon.
Awesome. As a tradition to this podcast, you're a new guest. So what happens is you kind of need to share how much leverage you guys have. But we'll make an exception today because you guys run a fund. So you guys can tell us what the leverage that you guys have in your fund and sort of what's the portfolio sitting at the moment.
So in terms of commercial property, we're quite lowly geared. So we're only at 40%. So you can, with commercial property, go to up to 60-65%, but we're running at 40%. And so currently at just over 40 million. Is that right, Jack?
Yeah, definitely.
Yeah, so reasonable amount of debt, but as you know, the leverage works.
Yeah, and we'll get into a little bit more why you might stay at that LVR as we sort of get along with the podcast as well. So that's really awesome. So it's the first 100 mil portfolio we have on the podcast. That's going to be a bit of fun that we're going to have a lot of learning from. So with my first question here, Carl, I wanted to know because from previous sort of podcasts and listening to you as a guest speaker, my understanding was that you were quite big in residential, and then sort of later on, you transition into commercial real estate. So what I really wanted to just get the audience to understand is what inspired you to sort of make that step, and what were you thinking about? What problems were you trying to solve with commercial real estate that you couldn't do with residential?
Yeah, I guess, Landon, the main thing is when you're a residential investor, you're there for the long term, looking for capital gain, and you don't get a lot of cash flow. So, and most of the rent goes to pay the mortgage, and but in the end, you end up with pretty good gain in equity, and you get to a point in your life where you need some cash flow, and that's when I started thinking about commercial property, and reading books on commercial property, and really just learning about commercial property, and so yeah, the main thing is for cash flow, and I think Jack would agree with that as well. You get much better yields, you get much longer term leases, so less hassles, and so it's really turning that equity that you've made in residential into cash flow, real money, so you don't have to work all the time.
I see. Is it okay, maybe you can give us a little bit more insights on where your residential portfolio was at before you started thinking about this? Like, perhaps you might run into that challenge like on a weekly or monthly, and then finally you got a light bulb moment to try and figure out, okay, what do I need to do next?
Yeah, I think it was just, having a young family and needing a bit more real cash money made me sort of think that, that we need to turn those residential assets into cash flow, and I'd been doing residential for 20-something years and made some reasonably good gains, and had properties in good capital gain areas, which is really, really important because a lot of investors that I knew went out to the cheap areas. And even though you're getting less cash flow, it was really important to invest in those high gain, capital gain areas like was quite a while ago, but so that was Greyland, Ponsonby, Mount Eden, Mount Wellington, Glen Innes, those Auckland areas, and so did pretty well there. Got sick of being a landlord and all the hassles. Jack's just jumping into the Hamilton area, which he'll tell you about, and he's got commercials down there as well. So he's kind of doing the transition and doing both.
Yeah, I see.
Yeah.
So perhaps, Jack, you can share a little bit about what you've learned about the sort of difference, having residential and having commercial. What is the difference for you, and sort of like why would you consider the alternative?
Yeah, I think the key difference for me about having both of them was that the residential market, you were reliant on the residential market as opposed to and strict, tidying up the building. So cosmetic items like painting, redecorating the bathroom, redoing the kitchen. That's the way to add value with residential, and what's quite common. That's what I did on some of my original residential properties, which is where I started in Hamilton as well. But then with commercial, what we found being in commercial for the past 8 years now, it's much easier to create and add value, and that's simply from renegotiating the lease. So the key difference between commercial property and residential property with commercial is you can create and add value from renegotiating the lease. So it's all about the lease agreement you have with the tenant and then who the tenant is. So it's much easier and better to add value, and there's really good cash flow that can be gained from commercial property.
I see. So one of the things that we talk about with our audience is the 3 C's in properties, right? We've got the cash flow, basic, the rental income that comes in. Obviously, from what you guys are sort of advocating is that the cash flow often is slightly better because you don't have as much expenses in a commercial property.
And and just to add to that, another key difference is the tenants pay a lot of the outgoings. So a part of the operating expenses, such as your management fees, your insurance, your rates, which you have to pay as a residential owner, is actually passed on to the tenants in most leases. So you don't have to pay those, which is great.
Key difference with commercial yields is that the commercial yield is a net yield normally when you talk about 7%, because all the, like Jack was saying, all the outgoings are taken care of. But generally with residential, you talk about a gross yield of whatever, and on top of that, you've got to pay your rates and your maintenance and things like that.
Cool. So now that's the cash flow difference. Now, in terms of capital gains, from your experience, sort of how does the capital gains work in a commercial? Because let's say if you lock in a 6-7 year lease, whereas residential is kind of looking at the average 7% market return over the years. How does the commercial one differ?
Yeah, so there's 2 components. There's the market. So commercial will have its ups and downs, very much like residential, and you'll see market gains, but there's no real kind of rule of thumb. But the good thing about commercial is that you can always buy commercial property in any economic environment and add value simply by changing the lease. So Jack and I like to talk about the pen and the paintbrush, which is a difference between residential and commercial. With residential, you're painting stuff and you're adding bedrooms and you're spending quite a bit of money. But with a commercial property, you can go along with a new lease and your pen, quite cheap ballpoint pen, and you can add literally hundreds of thousands of dollars.
Okay, so moving on from the cash flow, we talked about cash flow, capital gains. So what you guys are sort of alluding to is not only is it the market capital gains, but also you're looking at potentially what kind of lease you have. So you can make it worth a lot more if you can negotiate better terms. And I guess that's sort of the other thing about residential is, we always talk about capital improvement, where you could add money to the deal to actually increase the equity position or cash flow. And a lot of it at the moment is about development potential. like, are there a lot of that in sort of like commercial as well in terms of development potential? Does that actually add to your valuation a lot of the time?
Yep, hugely. It is definitely taken into consideration. And what we like to do is we like to try and build that into the leases. So your development potential might be, it could be a huge rear yard section that comes with part of the building, and that might be under rentalised. So as long as you've factored it into part of the lease, and it mentions within the lease that the current tenant or tenants occupy or you make use of that space, you can capture that on the next rent review. So that's one way to unlock that future development potential and actually utilise it for cash flow or future gain. Or you can also factor it into the price so that maybe they're not using it, but that's spare land. So you can create something from that additional land, which is actually a premium to the price.
Talking about Provincia again, maybe you can share with us the story of how you guys sort of got into it and what drove you guys to pursue, starting this commercial property fund.
Yep. So we, Jack and I ran, through our learnings, we learned a lot about commercial property through owning our own stuff. And we ran courses on how to get started in commercial property. So, and we assisted people to find properties and set them up in them. And we had a group that wanted exposure to a bigger commercial property. So, and there was 7 of those. And they, and basically Jack and I formed our first syndicate. So it was a $4 million property with 7 investors, and we managed it. And so we managed all the finances as well for that very first property. And then that was, 6 years ago, Jack?
Yeah.
So that was 4.2 million we purchased that for. And Jack had a lot of fun. He was a project manager on that, fresh out of uni. And but it had no co-compliance. So the owner, who was also the tenant, had done all this work without consents. So Jack and I went in there and we had to assess what it was going to cost to fix it up. And Jack had a lot of fun project managing and eventually got this co-compliance. But by doing that, it was a bit of a do-up. The leases were not very strong. They were very short. So we bought the property for 4.2, spent about 200 on it. Today that property, what's the valuation, Jack?
Just 7.8 million.
7.8 million. So that's a little bit of the market. A lot of buying well, because this property had sat on the market for about 2 years, had all the real estate signs falling over on the pavement, and that alerted us. We thought that was an opportunity.
Yeah, so that's actually quite interesting. So you guys syndicated that deal, but without the consents, did you have to get all cash from the investors, or did you actually finance some of it as well?
We had it, that first one was 45% financed with the bank, because what we did is, under the due diligence, when we were assessing what it would cost us to get the CCC in place, we got a certificate of public use, a CPU, in place, which means the tenants can keep trading in the current building whilst we undertook the work to get the CCC. And so the banks were happy with that, because we had all the project laid out, what needed to be done. We had it all costed and what had to be done to get the CCC, and we got that CPU in place before we went unconditional, which kept the tenants trading.
So that's quite interesting, because like in a residential property, it's unlikely, even if you can get some costing on how to fix that property, you're not going to get main bank finance. Maybe you potentially get second tier finance. Like, was that done through a main bank or sort of like a second tier finance?
That was done through a main bank. So we had to have certainty that we could eventually get those CCCs. So we had to get a lot of engineering advice and building advice prior to getting the loan. And so part of our loan condition was that we got the CCC by a certain date. But they still let us draw down the funds for settlement. So so eventually Jack got all the co-compliance, and it was a bit of an effort, but he got it done in the end, got it ticked off. I actually framed his first co-compliance certificate, and he has it on his wall in his office.
It sounded like quite the journey and a lot of learning in there. And so the interesting thing, what you guys sort of talk about is obviously there are so many things to unpack here, because I think maybe the first one is perhaps what was the capital position after you actually did all of the work that you wanted to do. You obviously put the pen to paper and got some new leases. You got the work of the CCC done. Do you guys remember what the equity uplift? I'm pretty sure you would remember your first big win. So
yeah, definitely remember that.
Yeah. So it's pretty much immediately valued up to just over 6 million, and with a total cost of 4.5.
4.5.
And
wow.
then the market's done a bit of work, so it's up around 7.2 now.
Yeah. So there was a 25% gain on equity, and then also what was the cash flow position on costs at the very end?
So total costs in the end were about 300,000. Jack,
just
about that.
Just shy. Yeah.
Oh,
Yeah.
sorry. What I was saying was like after you change the lease, what was the net yield on the cost of 4.5 million?
That's a good question.
Yeah. So we're getting 205 from one of the tenants, and then the tenant at the rear was actually very under rented, so we didn't actually get that uplift in that rear tenant until midway, about 6 months in. So that was at the end of the project, because when we bought it, we realized that their lease had been tied into a CPI, so Consumer Price Index rent review, which means their rent they were paying was very much under rented, under market rent. So they're on a cheap rent. They were actually only paying just over 100. So at the time, so we had 205 in the front, 100 at the back, and then there was one other tenant paying 30. So what's that?
335,000, and then over 4.5 million costs. You're looking at a 7.4% net yield.
Yep, and that's just the beginning, because six months in, we got a real big upside when the tenants at the back left, because we were able to get a new tenant in on a substantially higher rental amount and much better lease. So there was more upside that we unlocked during the first 6 months.
So what happened with the rear tenant, Brandon, was that they were on a what they call a CPI inflation-based lease. So their rent hadn't caught up with the market, so it was way behind. And when they called us into the office to say they wouldn't be renewing their lease, Jack and I couldn't keep the smiles off our face. Because we were able to get a new tenant in there paying market rent. And what was the uplift in that, Jack?
The initial uplift, so that went from 100, which they were paying, to 165. So it's another 65 grand.
So basically you're on 400,000 now by the time he left, and then now it's on 4.5 mil costs. And so at the end you got like almost 9% yield, 8.89% net yield. That's amazing. Like, can I get on the next syndicate, please? No, well, this is really awesome, because this case study kind of answers almost like 3 questions in one go. But what's really interesting is, because you talk about a syndicate, and maybe you can give me the basics of what a syndicate actually means and how do you structure one?
Yeah, so our first setup was, I guess it was syndicate, so it was a limited liability company, and all the shareholders had a proportional share in that company, and the company owned the property. So that's quite a typical structure. And if it was to be just a syndicate on its own, it would just stay like that, and everyone would get a share of the profits at the end of the year, or the dividends. But we just grew that company, so it was just a single company, and still is a single company, and we now own 13 properties worth about just over 100 million, and we have 138 investors.
Yeah.
But it's the same company, so one company owning all the properties, and the shareholders own shares in the company. So it's really simple, and we thought that was the best structure. So the difference between a fund and a syndicate is that a fund is much bigger and owns lots of properties.
Yeah. So syndicate, I guess if you could do individual deals. Like it's usually more about individual deals where maybe the property fund, my understanding is you've got a lot more diversification like as soon as you come in. Would you say that's about what it is?
Yep, that's the biggest bonus. Say if someone was choosing to invest in a small syndicate that had 3 or 4 properties over a fund, which is what we are, it is that diversification. It's having 23 tenants versus say 5 tenants. You know, if a tenant goes under, it's not a biggie for us because we've got 23 tenants paying multiple streams of income. So syndicates, your risk is a bit higher.
So we talked about how you guys are sort of like only using like 40% leverage, and then we talked about like these joint venture entities where you have multiple people owning the company. Now, residential investor, they love coming in to ask about this question, like, oh, like I've got a few friends, like we want to buy a property together, and the answer is usually like, no, you can't, because the more people you add to a deal in a residential property, the more complexity it is for financing, because there's a multi-household expense calculation, which makes it a lot harder when they're trying to do joint ventures. I mean, in some situation where, you know, everyone is in a very strong financial position, yes, it could work. But, you know, like it doesn't work for like the average residential, you know, mum and dad trying to invest with the kids. But in your situation, you guys are talking about like a company with multiple shareholders, you know, like your first deal, you got 7 investors. And so maybe you guys can give us a rundown on the financing terms for commercial properties, and maybe you can walk us the advantage of structuring a deal like this.
Yeah, so if you're an individual, you could probably go to a maximum of 60% on a commercial property. Because we're a fund, and because there's no personal guarantees, so they don't look at all our individual. So it's a good thing. So we're 40% LVR, and that's our pretty much our maximum with the bank, and anything over that, they'd ask for personal guarantees. So they'd be looking at our individual shareholders' financial position. But if we're under 40%, they just take the property as security, and they're happy that it's a low LVR, and they look at our rent income, our rental income, and our serviceability. If you're an individual buying a property, they'll obviously look at your other assets. Most people get started in their first commercial property by leveraging their residential, so they can get residential lending, which is use their residential security as well. Jack, do you want to?
Yeah.
Jack's just going through this at the moment, so
yeah. Exactly that. Yeah, so they either made their money in residential, whether that's by realizing the gain by selling a residential property. I've done that in the past. So my first couple, I sold my residentials, and that's how I got into my first commercial myself personally. So I took the equity, realized the equity in my residentials, sold, and then I used that money with bank debt to buy the commercial property. Or we've seen a lot of our investors from what we used to do, they leveraged from their residential portfolio, which Cal just touched on. So using their equity that's in their residential property, leverage off that residential property to buy commercial property. Yeah.
So let me try and unpack this, and correct me if I'm wrong at any point. So my understanding of what Cal is explaining with the general security loan is that you can borrow on a commercial property without looking at your personal income situation, but it would sort of limit to that 40% mark.
Yeah, 40 to 45, depending on what the bank covenants are. So with our bank covenants, Cal mentioned it's 40%, but it's a general security agreement. So basically the way it's structured is the banks have the security over all the properties. So all the properties, they've got a GSA, general security agreement, across. And that's why the leverage is quite lower rate of 40%, but they've got security over the lot. So there's no personal guarantees from any of the directors or any of the shareholders.
So they have a general security agreement over the company, and they have the mortgage securities on the properties.
So that's the secret to scaling the portfolio. And I guess, am I assuming correctly that perhaps an investor comes in on the fund, they might come in with cash, but they don't have the debt obligation under their assets and liability as well. So they basically get leverage on their money when they put their money in, but they don't have that liability on their balance sheets when they go back to the bank to borrow personally.
Correct. So they've got exactly that, no liability on their balance sheet, and some of the banks will recognise the income, so the dividends from the shares. So they'll take shares in the company. Minimum investment's 50,000, but some banks will recognise the income from those shares.
Perfect. And so sort of what you're talking about, Jack, is like you're in this position where you're transitioning from residential to commercial, essentially sold some, but you're still able to maybe borrow off your residential equity and get residential terms on those on that property, and then for the rest of it you're just using cash. So you're still getting the residential terms like interest rate, interest only, 5 years, 30-year term, but you could buy a commercial property that way because you've got a lot of equity.
Yep, exactly. That's one of the best ways to do it. So you get some really good rates, your residential rates, your long term, and then you use that to purchase part or all of the commercial property.
That's awesome. And the one thing I did want to ask before we move on to the next question was, because we talked about the upside, you've got massive equity gain in that property, but obviously there were probably some massive hoops that you guys have to jump through, probably like a lot of stress as well. Like it will be really good. Maybe perhaps you can share some of the unique challenges that commercial investors actually face as well, even though they got obviously a higher upside, but usually the theory of financing is that with higher returns you're expecting a higher risk. What are the risk and challenges that commercial investors face?
I think it's just the complexity of the commercial property, and in terms of understanding the leases and being able to get a good lease and secure tenants on a long-term lease. There's also the project management side. You have to understand a fair bit about building and engineering and dealing with the council. It's a little bit more complex than residential.
Just a little bit?
Yeah. A little bit, Jack. Yeah.
Especially with the lease.
Tell us what's the difference in terms of the documents. Like a tenancy agreement might only be like 4 or 5 pages. What are you looking at with the typical commercial lease?
General deed of lease, so your Auckland District Law Society leases, they're about 45 odd pages long, and that's just a generic one. And we've seen leases that are anywhere over 100 pages long, because anything can be added to those commercial leases.
So with residential, you're restricted to the lease that the government has drafted, or the residential tenancy agreement. With commercial, you have the basic agreement, the Auckland District Law Society agreement, and as Jack was saying, you can do anything to that lease. You can basically stipulate that the tenant has to come around on Sundays and mow your lawn every 2 weeks.
So you can get creative with it. That's what you're saying.
Yeah.
No, that's really awesome. And so I guess for a newer investor, sort of like from resi going into commercial, what do you see as the biggest thing that they should try and overcome or learn about first before they get into it?
I think it's like anything. When you're getting into residential, you read hundreds of books, and we did the same. We had both got big libraries of books about commercial property and investment, and we're fortunate enough to have a couple of good mentors as well. People who'd been in commercial property for 50 years, and they were always willing to help and point you in the right direction. So it's just learning about the lease is really important. It's really just having a go. It's going out with the agents, or not literally going out with them, but going and meeting
what would you say were your 3 most memorable books that you've read on commercial? What would be your recommendation?
Probably Jones on Property for me. I don't know, what about you, Jack?
Sir Bob Jones?
Yeah.
Tough one. That's a really tough question, actually. There's a really good one. It's an Australian book. It's Rethink Investing. I don't know if that's a really good one.
They make it a lot simpler, like for the average mum and dad, what it is. And there are some pretty cool deals that they show as well in there.
Yeah.
So.
Yeah, but I think the key takeaway on as well as reading those books, as Cal touched on, is definitely understanding the lease. And not a lot of those books will go into detail on the commercial lease. So that's why if you're doing the reading the books, understanding commercial property, it's a good idea to touch base with those agents like Cal mentioned, but get copies of those leases and actually start reading those leases, because all of those clauses in the 42-page lease or a 100-page lease, you need to understand, and then how they impact the property. So I think that's probably the number one key difference to residential, and the number one thing I would recommend doing about getting into commercial property.
Also valuations. If you got a friend or parent or something with some commercial valuations, Jack and I are quite nerdy. We like reading commercial valuations, but because we like to keep up with the market and things. But you learn a lot from reading a commercial valuation. You learn a lot about the property. We always get a council file as well, so the full CD about the property when we're looking at it. And
do you see that changing quite a bit in terms of how they value up a property? Do they look at different things at different times of the market, or what is it that changes over time?
Well, the market cap rates do, but that's only in relation to what other comparative properties are selling for. So especially with commercial property, it's all based on comparative market evidence. So you'll see a bit of a pullback in the current market, and that's in line with what interest rates are doing. The interest rates have gone up, sales have gone backwards a little bit, but not nearly as much as the rise in interest rate. So that's quite a common trend in this current market, but it's all based on what people are transacting for on similar assets.
Is there a rough idea on where those cap rates are sitting at the moment in different key industries?
I think 12 months ago you were just over 5%. So now they're sitting around about 5.5, 5.
Yeah, 5.5 to 6. And then in Auckland, and that's industrial, so industrial property in Auckland.
Yeah, so I thought what would be also interesting is maybe understand a bit more about your guys or Provincia's investment philosophy and sort of what your strategic vision looks like, long term. Obviously, you guys want to grow a lot bigger and want to scale this, and perhaps you can share a little bit about that.
Yeah. So our main, mantra or philosophy is to buy value-add properties, and both Jack and I get that a bit from our residential investment days as well, because you want to buy a tired residential property and flick some paint on it and get a good capital gain. So it's just looking for those kind of do-ups and value add, and I think we're one of the only funds that are doing that. So what we look for is a building generally with a tenant already there, and we look for something that's under rented or has a short-term lease, and something we can add value to within the short to medium term. So we're giving that rent, getting an immediate rental uplift, and therefore a value uplift. So and we do that with every building we buy, and it's kind of it's quite refreshing seeing that our valuations are going up and quite a few of the other bigger companies' valuations going down.
That's awesome. Yeah, I recently was listening to Grant Cardone's interview on Bigger Pockets, and it was quite interesting. He was basically talking about how he's always buying well undervalued, these massive funds. They've just got so much money that they have to park it somewhere, and they often buy deals that are slightly just overpaying. And right now, the smaller guys that are paying more attention to the deals that they're actually picking up are winning a lot more. I wanted to understand a little bit about, because say for example a residential developer, they might look for a piece of land and they want to work out, whether or not there's around 25% margin if they sold all those property. So you guys talk about value add. Like, is there a specific target that you guys at least try to go for to mitigate your risk?
Well, the good thing about commercial property is you can get a very long due diligence, and so Jack and I, or Jack will find a property, I'll find a property, we'll both go and look at it, get it under contract, and we don't ever go unconditional until we know for sure that a valuer has said, yes, this is a great deal. Within X number of months, you can put the rent up to this. It's very, very mathematical. Whereas residential, you can take a stab in the dark, but the market determines the price in the end. So commercial properties are valued purely on investment basis. So how long the lease is and how much rent is coming in. So basically we know pretty much what value we can add by getting that valuation advice, and we work out how much we have to spend, if any, on the building to upgrade it for the tenant. And so we get quotes for that, so we know exactly where we are financially. So it's just a very mathematical business.
Yeah. So the interesting thing is, because you're talking about mathematical, and then also like the first deal was like a mega deal with a 25% margin built in pretty much after you do everything. And obviously, because with this kind of business, you're looking at the cap rate, you can maybe project what it looks like potential on the lease that you're getting. Would you try to at least go, you know what, if we don't get at least 10% undervalue, or like if we can, get the cap rate and increase the value by 10% or something like that? Is it like a specific number that you aim for? Or is it like a trade secret?
Yeah, no, it's not really a trade secret. 25 is very good. 25 to 30 is really good. If we can add over 10 within a short time, we're pretty happy. 10 or 15% on the rent and the value. We're quite happy with that. Keeping up with inflation, that's the main thing.
I think every property we've got in the portfolio, so we've got a total of 13 now, has a different story behind it on value add and a different aspect, which is really cool. And I think that is the criteria we're looking for is okay, is it going to have some value add? What angle is that? Is that capital gain, or is that rental upside? And we always look, does it add to the cents per share? So that's probably our biggest calculation when we're analysing a property, is what is the future upside going to be, so that we can add to the share value of the fund, but also what is that going to do to the cents per share, so the cash flow that the investors are receiving. So they're the two metrics we're always looking at.
Yeah, I gotta say though, like Jack, to expand what you were saying, is like the story behind the properties. I remember first time sitting down with you guys, like I can tell every single property you guys went through so much to get it, and there's just so much passion in each deal, and I love that about when I sat down with you guys to talk about it. So yeah, definitely. I think will you find some of those stories on your YouTube channel that you guys sort of just released as well?
Yes, some of them are there. Yep.
Yeah, perfect. Yes, definitely check that out.
Yeah, so we don't buy every property we look at. We look at a lot of properties, and we get a lot of properties under contract, but there's only a very few that we end up buying. Probably 1 in 10 or something like that.
Yeah, at least. Yeah.
I'm just curious to know though, like let's say if you like get into the commercial game, and you're only just aiming to do one deal every 2 years, right? What sort of time would you allocate to be reading leases? Like, because it seems like that's the most important thing. And then also trying to learn how you can be more creative with those leases. Like how much time would you be spending if you're just looking at like one deal every 2 years, but you want it to be like a decent 10% below market value deal?
It's kind of part of the process. So if you start looking, you may look at 10 properties before you buy one, and each one of those properties you're going to do your due diligence on. So you'll order what they call an information pack from the agent, and they'll and you've got to make sure you get a separate email address because once you get on the agent's database, you get an email every 5 minutes. But but they'll send you all the information on the property, everything that you need to know about that property before you buy it. So it's just really, if you even go through that process, you learn a heck of a lot about commercial property, and then and you get more and more comfortable, and by that time you're ready to buy your commercial property.
Yeah. So like, let's say typical DD process, what would you assign? Like, you probably commit some hours. Let's say, obviously you probably do in a shorter time because you guys are so experienced, but what would be like a newer person, like they should maybe commit to, like how many hours you think for a DD process?
They'd have to put hours into based on what their experience are with commercial property, with leases. So they would need to understand that all the clauses in the particular lease that they've got in front of them. We're quite an expert with a lot of those clauses and those leases, so it's quite familiar to us. We read probably anywhere between 20 and 30 leases a week when we're doing due diligence. So we know the differences and we know what to look for. On someone beginning, they'd spend, I would say, at least hours just analysing that lease, but they need to understand the impact of every change and the impact of the legal impact of the wording of the different clauses. So that's where, again, I would recommend the most time is spent undergoing due diligence. So once you can get that down, then the rest is investigating the building, the council file, the initial earthquake procedure, that's quite a big one, the insurance policies, and then what the growth is. So understanding a particular location in a particular market. So that could be industrial property that's based in East Tamaki, and knowing what particular properties are selling for and what the rent per square metre is in that particular area.
And you can find a lot online. So if you go to the bigger commercial real estate companies' websites, they have a research section. So you can jump on that. You can see what the rental rates are for that area, what the yields are, and there's a lot of free information out there that you can get through the real estate sites.
Perfect. So where do you guys want to take Provincia? Tell us the big vision. Where are we going?
Well, we're at 100 million now, and we would like to think that one day we may list, but that will be also up to the shareholders. And when you're listing in a buoyant market, but to do that, we have to be over 200 million to make it economical. It'd be nice to think one day we'll list, and that's where our shareholders will get the ultimate liquidity and the ultimate uplift in their shares. So that's.
Might happen in the next period. Won't take long, it sounds like, but depending on what your shareholders want. So my next question here, what are some of the benefits of investing in commercial property fund like Provincia, as opposed to like just buying directly, investing directly, and trying to manage a property portfolio themselves?
Yep. So with a fund, everything's taken care of. So we designed the fund so it's actually very close to direct ownership. And really the only thing you can't do is use the properties as your personal security, but you pretty much get all the benefits that you would get from a normal property. So you get your cash flow and you get a share of the capital gain. So that's the way we've designed it, and everything's managed, all the finances are done, and investors just get their dividends and their gain in their share price. But I guess the downside is possibly liquidity, because we're a relatively small fund, and with your own commercial property, you can have a bit more control. So you can use your own commercial property as security for buying more property, or buying a residential or another commercial property. So it's and you also, with your own property, you're limited to that property and that tenant. So, and with a fund, we've got multiple tenants, so it's probably less riskier.
Yeah, and you're giving away like a lot of that initial equity gain as well. Like if you're doing an undervalued deal, so basically you're their property finder if they're working with you, right? If they come into your fund.
Yeah, that's correct, and plus the investors get exposure to much bigger commercial properties, and it's just more sort of horsepower rather than owning a you know, the 20 or 30 metre shed or a garage.
Would you expand on it a little bit more? Like, what would be the different risk levels looking at a bigger commercial versus a small one?
It's just so quite often we have multi-tenanted buildings, and with the there's more So the idea of the fund is to spread your risk through multiple tenants and multiple buildings, and plus having that exposure to a bigger property rather than a small shed.
We get our fund invests in properties that are 5 to 10 mil, so that's the range we invest in, and we get really good professional tenants as well. So that's just to expand on that. We don't get small, tradie type tenants. Not to say they're bad; some of them are really, really good. But you just get that exposure to that next level of the type of tenure we've got, and they generally sign long-term leases. So there can be substantial upside in the type of buildings that we're in, that 5 to 10 mil range. And then that's passed and reflected in the valuations and passed on to our investors. So that's another big key point of difference, as opposed to someone maybe without as much firepower and can't go to that level.
And the biggest thing is that the yields are better with the bigger properties, because with the smaller properties you're getting a lot of competition. So the pure competition of people wanting to buy, say, a $500 to $1 million property, or even up to $2 million. There's a lot of people wanting to buy, and so that because of the competition, they're prepared to pay more. So that's and the rental income is obviously fixed, so the yields are dropping. So it's having a bigger building, generally you get a much better yield and return.
And we've got some substantial tax advantages as well. So our fund is a portfolio investment entity, so a PI fund. So we can write off a lot of our taxes on the dividends that the investors receive. So what was the current dividend that just went out? The tax.
Yeah. So what happens is that with commercial property you can claim depreciation now. So that obviously comes off as a tax deduction. So because Jack was saying, because we're a PI fund, the investors they take advantage of that because they're shareholders, and so quite often, if we have enough depreciation, they're not actually paying tax on that dividend, which is a big advantage.
So perhaps just to expand on that, like, because with residential property, like the only depreciation you can claim is the chattels, and that just comes down as a tax deductible expense. But in a commercial property, what sort of things are you claiming as depreciation?
Yeah, so originally when we first went into the fund, it was just chattels, wasn't it, Jack?
Correct, yeah.
Yeah, and just recently they've changed it back to the building. So we suddenly got all these buildings which we can depreciate. So that's a lot of depreciation. It was 2 years ago. It was around the start of COVID, I think. No one knows why, but it was a great thing for our investors.
Jacintas secretly have a lot of commercial buildings and don't like residential investors. I don't know, maybe.
And that's another big advantage for us as well, because the investors get their tax done. We pay the tax and calculate the tax on the dividends. So when our investors get their dividend statements, they've got it all calculated for them and depreciated on the dividend that they receive.
And if they do pay tax, we pay all their tax at their prescribed investor rate, which is their PIR.
So the other question is, because in the States, right, if you claim depreciation, then obviously you have to pay tax up on the sale of the property. What happens in a commercial situation where you're claiming depreciation in the building? Like, let's say, you have to recycle some of the properties, like in the future, what happens to like the tax?
Because we're a long-term fund, we don't have a stated time where we finish. So we're there for long-term capital gain. So if we're doing what they call portfolio adjustments, say selling one property to buy another one, there's no tax implications because the capital gain's being put back into the fund and it's being basically recycled to buy the properties. Whereas, as you know, if you're a developer, so you're buying to sell, that's where you get taxed on your capital gains.
I always think that's a really, really big loophole in the commercial space. Like it all comes down to your intention and it changes your tax outcome. But yeah, like it just sounds a bit loophole-y. I don't know a better way to describe it, but it's a very good loophole for commercial investors. Okay, so perhaps, because I do have a couple of clients, like we've talked about you, like I got them a revolving credit, they put like 100K in the fund, but maybe you can walk us through like how an investor can get involved with a property fund like Provincia. What's the process like for sort of getting in?
Oh, so I think the easiest way is to get a hold of us. So we've got our website, which is www.provincia.co.nz. So we've got our investment statements on there, and all the history of the fund, and a few webinars on there too, and links to listen to. So I think the best way would be to go through that and fill out the contact us form, or download one of our investment statements so you can understand what the product is and what the fund's about. And then anyone's got more questions and they want to speak with us direct, our office is pretty much open always, so we're happy to sit down and have a chat to any prospective investors that are interested, or they can fill out our forms, which are also on the website. So we make it really easy. So if you want to contact us, happy to do that. If you want to fill the forms out, they're all on the website, and the investment statement's probably the first part to download and understand.
And it's just really important to note that Provincia is only for wholesale investors. So Financial Markets Authority say that because we're a wholesale fund, everyone that invests has to qualify. So they have to have experience in investment and also buying and selling financial products. But that's all part of the application, and you don't really know until you apply.
No worries. Like if they have a little bit of equity, like our advice is always to explore residential properties to begin with. But perhaps once they have a bit more equity, I think they would qualify as a wholesale investor, and also it would make a lot more sense to start exploring opportunities that's going to have a bit more cash flow as well. So that's really good. But definitely, I think for everyone who is listening, you should check out exactly what a wholesale investor is, and that's an important thing that you need to know. So finally, I just want to know, what are the risks with a property fund, and how do you guys try and mitigate for these risks for the investors?
I guess the biggest risk is all the tenants leaving and you having no income. That's the extreme. So you have to invest in good areas. So we invested in Auckland mainly, and we've got one property outside Auckland, still in a good area. So we know that if a tenant leaves, we can virtually get another tenant the next day. And Jack gets himself in trouble sometimes when the one tenant's moving out and the other one's shifting in at the same time, but he's got a very good track record of 100% occupancy for the last 5 years. So so that is biggest risk is the tenant or tenants leaving and losing your income.
Yeah. What about perhaps like interest rate risk? How does that factor in a fund like Provincia?
Yeah. So because we're leveraged, we have that risk, and at the moment our dividend is lower than what it was before because of the high interest rates. So we're currently looking at a refinancing and looking at refinancing options to get that interest rate down. And we're also looking at ways to reduce our LVR with our subsequent property purchases. So it's just lowering that interest rate risk while the interest rates are high.
Yeah, just to elaborate on that, the last property we purchased, we bought at a substantially lower LVR. That was just December last year. So that's what part of the strategy which we're implementing.
Yeah, so that was at 30%.
Yeah, correct.
Yeah.
Yeah.
That's awesome. So trying to lower the amount of lending like that you take on some of the new deals when the interest rate is higher, and that's going to allow you guys to have a bit more cash flow for the investors.
Yeah, and like everyone, we're hoping that this high interest rate environment is temporary, and then of course, as you know, you get the benefit of the leverage when you're out the other side. So we don't want to go to zero LVR. We just keep it at a good level.
No, thank you so much for sharing your knowledge and so generous with a lot of that wisdom. And I think the audience is going to find a lot of value in that. And hopefully you guys get sort of like more people educated and interested in commercial, because I definitely am. And it's something that I'm hoping I can learn a lot more from you guys as well. So if you guys need to reach out, obviously provincia.co.nz. Yeah, until next time, we want to say thank you, Carl and Jack, for coming on and dropping those knowledge bombs.
Thank you.
Yeah, thanks for inviting us along.
Again next time. And all I ask for is one thing in this podcast, is that if you guys have found value, please share this with one person that's going to benefit from this information. And I'll see you guys next time.